it is something that's, coming up quite often, and people are talking about it as time goes on, especially as leverage becomes a more sexier thing, right? And it doesn't matter what space it is, if it's real estate, if it's business, whatever, like leverage is the key to building wealth. Robert Kiyosaki talks about it. Grant Cardone talks about it. Like all these big ball players, everybody but your boy Dave.
Dave Ramsey is so if don't even type in what does Dave Ramsey think about premium finance, because number one, I don't think he has any videos or anyone has talked to him about that. And number two, he's going to hate it because you use debt to buy life insurance. This is BetterWealth with Caleb Guilliams. We're going to talk about premium finance, which is essentially how rich people buy life insurance or could buy life insurance. And to do that, we have Dominic Rufran, who is the asset specialist, the muscle man, the researcher, and we're going to draw you some pictures. Disclaimer, I don't know how this video is going to be, but hopefully it's good. And if it is, please give us a thumbs up, comment below. Yeah, how's that? I like set you up and then kind of cut off your legs in the process.
The thing is Caleb has no idea how any video is ever gonna go. If you watch like the last couple of videos that we've done, it's been very ranty and he's fired up and passionate, and we get a little off topic sometimes. So
I'm fired up because I've watched like 10 Dave Ramsey videos, and I have a notebook that's filled with response videos to Dave Ramsey. So I get fired up because so many people watch this guy, and I'm like, if I look at our views, I'm like, we should have 10 times more views. So that's why I'm fired up. I'm sorry.
No, that's okay. I get that, and I respect it. But today we will be talking about premium finance, and we can go a little bit more in depth as time goes on. If you have questions about it, like feel free to ask. But I think it would be a good overview to just discuss what it is, who it's for, maybe some things to look out for, because it is something that's coming up quite often, and people are talking about it as time goes on, especially as leverage becomes a more sexier thing, right? And it doesn't matter what space it is, if it's real estate, if it's business, whatever, like leverage is the key to building wealth. Robert Kiyosaki talks about it. Grant Cardone talks about it. Like all these big ball players, everybody but your boy Dave.
Dave Ramsey is so if don't even type in what does Dave Ramsey think about premium finance, because number one, I don't think he has any videos or anyone has talked to him about that. And number two, he's going to hate it because you use debt to buy life insurance. So can I just give an overview of what I think premium finance is? Okay, I'm teeing this up. So premium finance is for wealthy people because you need to have a net worth of 5 million or more. I know there's exceptions, but 5 million or more. And it's to say, hey, life insurance has benefits in the future, especially estate value benefits. So I want life insurance death benefit or the cash value income that life insurance can provide. And what I'm going to do is, instead of coming out of pocket with massive premiums, I'm going to go to the bank and I'm going to have them pay the premium. I'm going to pay the interest. Sometimes it can be deductible. And as a result, this policy will perform in such a way that I can pay off the loan in the future with my cash value, have a massive death benefit, and I'm out of pocket very little, and my estate will either get a massive legacy, and or if the math works out well, which we could debate all day long, you could have an amazing tax advantage income stream, and you could look like a genius because you use leverage to buy that asset.
Yeah, and I think it's important to have this conversation because there's individuals that are hearing about premium finance that may not be qualified for it, and it may not best suit them. It may not even be a need for them, but they think that because, hey, I don't have to put any money out of my pocket and I can get this massive death benefit and cash value perspective that I can borrow against and use, well, then it's got to be great. Like, can I get that, please? I mean, just hearing that, like, I can get this massive death benefit, massive cash value, and I don't have to put any money out. Obviously, I want to know that. I want that. But there's a lot more risks and factors that are involved with it that, we're not bringing up in just a day-to-day conversation. So, Caleb, you definitely teed it off right. I think that is a fantastic way to overview it. And here's something that I want to be clear in regards to who this is for, okay? Caleb mentioned that this is for a wealthy individual, okay, that has $5 to $7 million of net worth, or an exception can be $500,000 of cash of annual income on an annual basis as well. And there is a lot of restrictions around this. And I say a lot of restrictions because people were selling this, and there was a lot of lawsuits, a lot of policies that were lapsing, a lot of risks that were involved. Interest rates started changing, and people were like, hey, my policy is not performing. You're doing what it said it was going to do. Now I want to sue you. And, you know, if there's a lot of money involved, a lot of people with a lot of money, attorneys, et cetera, CPAs, people are going to get sued for this product. And so ultimately, I want to be able to just kind of state that this has to be set up for the right person.
Right.
It's got to be set up appropriately, and you have to understand the risks that are involved. And if you're okay with the risks and you still understand everything, then great. Then go ahead and move forward with it.
Right.
I personally do not believe that premium finance should be a cash value play.
Okay.
I do not believe that it should be focused on the cash value piece.
I agree with you, by the way.
The death benefit is a very, very attractive piece when it comes to premium finance for the right individual. And that right individual, I always like to say, if you cannot pay for this policy, right? If you cannot pay for this policy out of your pocket, more than likely you should not be thinking about a premium finance still. Okay, so let's just say the premiums were $100,000 a year. Okay? That $100,000 a year provided $10 million of death benefit. If you cannot afford that $100,000 of premium, more than likely you should not be considering something like this. So this is essentially saying, I can do it, but I'm choosing not to because I would rather have my dollars doing something different. Right. Because this is typically people who are leveraged in other adventures like real estate, ventured in business, having their dollars working from other places. And business, I don't want to tie up my capital into a policy, into getting this death benefit when I can have my dollars working for me.
Right.
Okay. But what I would prefer is that I still need that estate planning, or my family needs to be protected, and I need a lot of it. Right. And I can do it at a very cheap cost because the bank's paying for it. And the only thing that I actually have to pay out of pocket is the interest charge. Right. And you can get a very, very cheap interest charge at the same time.
Right.
So if I'm paying $100,000, you can get, rates right now, probably 2-3%, like maybe even lower. Like I don't know the exact rates right now. A lot of times they're like Wall Street Journal Prime plus a couple basis points, et cetera. You'd have to look into it, et cetera. If you wanted to work with someone to do it, like we could obviously set it up. We'd work with attorneys, CPAs, making sure the insurance company's on board, making sure it was the right fit for you, looking into all of those things. But just throwing random numbers out there. So if I paid $100,000 into that premium finance deal, right?
Yeah. So can I just repeat what you're saying? I actually really appreciate where you're coming from because, there's a lot of people that are talking about premium finance as a cash play. A lot of times we're using IUL, and in a perfect scenario, the caps don't go down, and all these beautiful things. You're seeing this income stream, and it's amazing, and a death benefit. And we're not saying that that's not possible. We're just saying that if you're selling a product based on leverage and how things work out, and you're going to make this amazing money, we're basing on a lot of assumptions, and in most situations, you're going to be disappointed. We're just telling you that straight up. But just how we love leverage and how we talk about the power of the and asset, you can put your money into a policy, you can borrow against it, the death benefit and cash value grow over time. You can do that same thing, premium finance, by essentially having access to the capital, having the bank fund the policy. You're still having all the opportunity cost benefits of having access to capital, hopefully building your wealth while you have your death benefit. And then there's so many other benefits of you could have a place to pour money in the future, all that. So I really appreciate where you're coming from, because a lot of people talk about premium finance as this will be amazing when it comes to income. And we know, because we know the industry, it's like, you're telling me that you're basing your financial life on an illustration, 20 years, nothing changes. It's risky. And that's what I'll say. So I just commend you. And I just want you to know how valuable that is by someone speaking to you straight, because you're not going to hear a lot of people talk about that.
Well, when we talk about the and asset is specifically for somebody who wants to focus on growth and growing, right? They still have time on their side to go build.
Yep.
So, hey, I need to go build my business, or I need to go build in real estate, et cetera. I can have access to my cash value, borrow against it, and use it to build and produce. When it comes to premium finance, you got to understand your policy is essentially being collateralized to where the bank has control of that, to where you can't just have access to that cash value whenever you need. So it's not a growth mechanism to be able to borrow and use, because the banker is saying, hey, I need collateral. I'm collateralizing this right now. You're only going to maybe have access to a very, very, very small amount, if any at all, based on the current growth and how long the policy's been enforced for. So it's just something that people have to consider as well. You can't just in like an and asset type deal, I can borrow whenever I want. You can't just do that when it comes to these types of premium financing deals, which is why it's another reason to consider like this really shouldn't be for a lot of people. If you're still trying to build wealth and try to build this massive empire, you're going to be better off 100% hands down focusing on an and asset, living intentionally, unlocking it, and doing all of the things that we preach and talk about.
Love it, man.
So we've talked about who it's for, right? We talked about that it should be for the wealthier individual. We've talked about essentially what it is, and I think it's kind of important to maybe conceptualize. You talk about something that someone can see from what that's on a day-to-day life. So if you have a house, right? Like let's just say so I have a house. This house is worth $1 million.
Okay.
1 mil.
Do you want me to co-draw?
Yeah, literally. 1 mil.
It's bad when I have to draw because I have better handwriting.
Yeah.
All right.
Okay. I have, let's just say, my bank account over here. I have $2 million. Okay.
Okay.
Could I take my $1 million of this 2 and buy this house?
You could.
I could.
Yes.
But would that be smart?
If I mean, it depends on the outside numbers, but probably not.
Yeah. Most people that are somewhat financially educated around math and money, etc., would not take my million and buy the full.
Unless your name is Dave Ramsey. I would say majority of people would say, I would use a bank because my $2 million can be productive and I can earn a greater rate of return. Be careful, our face is in the corner.
Oh, that's a great point. So the erasing is there. So I'll just put it down here.
Okay.
So the bank is then how you would fund.
That's correct.
A percentage of that.
Yep.
Okay. So think of it conceptually the same exact way. I have a life insurance policy.
Yep.
I have a policy. Wowzers. Okay. I have the million, the 2 million, but I'm choosing not to. Instead, I'm getting a loan from the bank.
Makes sense.
To fund my policy instead because I understand leverage and I understand control of capital, and I would rather take this $1 to $2 million and go use it for other activities.
Yep.
Okay. So it's the same thing. This $2 million, instead of funding it into my policy, I'm going to get leverage from the bank to be able to fund my policy.
Makes sense.
And at the same time, what ends up happening when you take the loan out? You need to do what? You need to get a loan, and you also need collateral.
Yep.
And what is the collateral in this situation? It's the house.
Yep.
If you don't pay, et cetera, they'll take the house. And this situation, if something goes south, the bank can essentially take the cash value in the policy, and they have that as collateral. So conceptually, think of it as the same way of like how it can be used, et cetera.
Right.
Okay. So,
and the whole concept is I can be more productive with my $2 million in the bank than shelling it out and either putting it into a property or a policy.
Yeah, 100%.
Yep.
Okay, so here's something that I want to just point out in why this is not essentially great for a cash value piece as well. Okay. There's a point in time where you have to figure out the exit strategy.
Yep.
Right. And at that point in time, like, what are you going to do? Typically, somebody may have a business that they're going to sell.
Yep.
They're going to get a large lump sum of inheritance.
That's right.
Or you have the means to do it somehow, or you could use the cash value of it.
Yes.
Okay. So if I have a policy where I'm essentially putting in $100,000 a year, that means I was getting a $100,000 loan from the bank, right?
Yep.
And typically these can be a lot more than that as well. 3% of 100,000 is 3,000.
Yes.
Yep.
Yes.
So then the second year is going to be 6,000. The third year is going to be 9,000. You do that over a period of time, you're going to get, $50,000 of interest,
yep.
That can accumulate. And that's money that's coming out of your pocket, and add those all up. That's a lot of money that's actually coming out of your pocket period of time. There's a point too in the policy where we haven't broke even yet.
Yep.
So if I put in $100,000, let's say the first year I have $70,000.
Yep.
Okay. In that moment in time, I have to also post collateral.
Yep.
That is the collateral that I have to pull up from my business, from a stock, from cash, whatever it is. And so if you don't have collateral to also put up, then you just can't do it as well. So it's something to consider is like, you have to have money, you have to have liquidity, you have to have a large estate purpose, you have to have all these different factors involved to it. And so I built up this massive cash value in my policy over a period of time. And then at the end of it, I don't have anything to pay for it except for the cash value.
Right. And usually it's over 10 years.
Yeah, typically 10 years. You want these things to accrue and build and to do.
And so the theory is you'll have more cash value at 10 years than what your outstanding loan is.
Yeah. Because at the end, there's a balloon payment essentially where you now have to pay off the whole thing at once, right? Because it's interest only. And then after a period of time, 10, 15, depending on the terms, you are now required to pay all that back. So how do we pay it back? Whatever we discussed, it could be the business, et cetera. But if you're just a normal person without any direct exit strategy, it would come from the cash value.
Yeah.
Okay. So I've actually looked at the math on this thing, and if I were to fund a policy of $100,000 a year into a policy, okay, I actually am funding my own money to it. Okay. And then I take $100,000 from the bank, borrow, right? Fund my premium finance deal, pay the interest, onto it. Okay. Then take my cash value, pay off, right? Actually pay off the loan from the premium finance deal, right? I will have more cash value in my typical and asset than I would available into,
of course,
100% of the time, because you have this thing that's building. So you're going to be better off, and you've paid a ton of interest along the way as well. So you're going to be way better off in the long run actually doing and funding an and asset than you would to be doing is if we're looking at it from a strictly a cash value perspective.
Yeah, and one of the reasons that is it's I guess you're charging 3% instead of just paying for the premium. So that's a factor that needs to be in play. But the pushback to that, in all fairness, is what are you doing in an external account by not paying the premium? So to do an apples to apples comparison is you are correct. If you're just looking at the policy on one scenario, you're saying I'm paying out of pocket and I'm not paying any interest. The other scenario, you're saying you're having the bank pay and I'm paying interest. And so you're saying at the end of 10, 15, 20 years, this account will be more healthy than this account after you pay back the loan and all this.
100%.
My question is if the person that used the bank, what are they doing with that other money? If it's just sitting in a savings account, you're not, math is not on your side. If it's building other assets, you could make the argument that you're going to be good. You also can make the argument that this person's sitting on money for the next 10, 15 years and not leveraging it. And so that's problematic as well. So overall, I think we both can agree that premium finance is for the person that can pay it, chooses not to, and then they need to have an exit strategy. And what you're saying is if the exit strategy is to pay off the loan with your cash value, rethink your decision. But if you have a business that you're selling, or if you have an inheritance that you're getting, or potential windfall, this could be an amazing vehicle because now you just have this massive asset. You didn't really give up a ton to build that asset. And oh, by the way, you're going to have other assets that you're going to be able to backfill into the policy.
Yeah, 100% agree. And I mean, there's some slight risk. I mean, not slight, but there's definitely some big risks that are involved with this as well, too. I mean, these are funded typically with IULs.
Yep.
So IULs are a product that, let's say a 2008 happens or 2007, 2008, where there's 3 years in a row where it's credited zero.
Yep.
What happens at that point? The bank lended you $100,000. You put in your money. You don't have a ton of cash value in IUL in the first year anyways, right? The second year you hit zero. The third year you hit zero. Fourth year zero. So now you have 4 years of just say $17,000 of the $100,000, but you've lent out $400,000 from the bank, which means you now have to have collateral for all $400,000 of that. And that's got to come from your business. Right. If it's using stocks, it's got to be twice as much of that. There's a lot of risk that can be involved.
Obviously, that's a worst case scenario.
Yeah, worst case.
What
obviously.
Most people would say is, in the history of the market, there's never been 3 or 4 down years. What I would say is what's more likely is for whole life or IUL to underperform the illustration. Whether it's cap rates, whether it's interest rates, whether it's the insurance companies changing their mind, whether it's them increasing the cost of insurance in a group of people. Like, these are all things that they can do. That's, in my opinion...
No, it's a good opinion.
A pundit on YouTube. That's my opinion. That could be a greater risk. And by the way, whole life is not exempt from all these things too. It just comes with the territory. And so, it's important to know premium finances. I think we're going to have more videos on this because there are cases, there's case studies that you'll look like a genius when you do this, and it's an amazing strategy. But you're playing with potential levers / risk that you need to be aware of.
Yeah, and one of the other things too is these loan rates they're variable, for the most part, right? And so if my loan rate goes up, and typically when it comes to dividends and caps, they don't increase as fast as loan rates increase, because typically insurance companies, what they're doing is they're taking their money and they're putting it in things like bonds, et cetera. Those things have to mature, et cetera. So the interest rates and the dividends and the cap rates will go up in the life insurance, but it may take longer to go up at the same rate of whatever that loan rate was. So if that loan rate now went to 5-6%, and I'm expecting my cash value should have went a skyrocket as well, that may not be the case for another 2 or 3 years. So puts another, pickle in it. So ultimately, I think what we're saying is if you understand it, you understand what premium finance is, you understand who it's for, you understand the pros and the cons, and if it's right for you and you still want it and you understand the ins and outs of it, then it could be a very valuable tool for the right person.
If you're still watching this video, you're a hero. you're a huge fan, and we appreciate you. So like the video, comment below, give us topic ideas, because we want to be relevant. We're going to continue to share the world, to live intentionally, and premium finance can be an amazing strategy to do that if you understand all the pros and cons. So with that, thank you so much. Continue to live an intentional life. Thank you so much for listening to the BetterWealth podcast. It would mean the world to me if you could hit subscribe, leave a review, and share this with the people that you know and love.